Hello, everyone. Welcome to Finance Friday on the ARC TV network. I'm Hard Money Jim. You probably know that. I'm speaking to you today from beautiful Jackson Hole, Wyoming. And we have a couple of very interesting guests today to discuss an interesting question. And my guests are they happen to be friends of mine. They all happen to be sort of ideological colleagues, I guess you would say. We don't always agree on everything we say. And I don't think these guys today are going to agree on everything, which I hope is true, because we're going to have a robust discussion on the question, or on the issue of what is investment? What is speculation? Is there a difference? And why does it matter? Why should you care? So let me first let each of these gentlemen introduce themselves. Seth, let's start with you. Seth Levine, you can see he's got this great background back there. He's the blogger of The Integrating Investor. Seth, tell us about you.
Yeah, hey, thanks. Yeah, this is just covering my dirty laundry behind me, so I needed something. Thank you, Jim, for that introduction. I'm Seth Levine. I'm a professional institutional investor. You guys can, I'll leave my whereabouts vague in that sense, but on this, in addition to kind of my professional activities, I do blog at the Integrating Investor website, which is, kind of a website that I kind of created to try and flesh out some of these investment ideas, such as what we're discussing today.
Great. And Keith, tell us about you.
I'm founder and CEO of Monetary Metals. The purpose of the company is to pay interest on gold, and we do that by financing productive businesses. There's a broader ideological point to the business, which is to help bring about the return of the gold standard.
Woohoo. And in full disclosure, I am on the board of directors of Monetary Metals. I am an investor and I am a client. And so I just want to get that out there. Hopefully that affiliation will not surface in the form of bias today. I assure you it will not. I want to say before we get started that nothing we say today or discuss today constitutes investment advice. So please consult your own advisors and do your own homework before you invest a dime in any of these crazy markets. But I think you'll see that today it probably wouldn't tread on investment advice anyway. Okay, so the question, what is investment? What is speculation? And why is this important and why should you care? So let me start off. We're going to narrow the term speculating and investing to their meanings in the context of financial operations. So we're not talking about, quote, investing in the time to learn a second language or speculating, on the rate of the sea level rise or anything like that. We're talking about how to use money either to gain more money or to obtain a greater value measured in money. So what I want to do right now is start with the Oxford English Dictionary definitions from my 2002 edition right over there on my bookshelf. And first, I'm going to give you the OED definition of speculation. The action or practice of investing in stocks, property, etc., in the hope of profit from a rise or fall in the market value, but with the possibility of loss. Also, engagement in a venture offering the chance of considerable gain, but the possibility of loss. So that is the OED definition of financial speculation. Okay, now, OED definition of investment. And this is interesting because you can tell by the definition, it's changed a little over time. It's an expenditure of money in something from which a return or profit is expected. And now, more recently, in modern usage, the purchase of property, shares, etc., for the sake of the interest, dividends, or profits accruing from these. So that's a little different from from the first definition of investment. Now, those definitions suggest that if you lay out money for the purpose of pure capital appreciation, that's speculation. And while if you lay out money for income producing assets that provide you with a regular return, such as dividends or interest, that is investing. Now, both those definitions describe an outlay of money with the expectation of a favorable payoff in the future. So one question I have right away for the OED here is, what's the right word for that concept? Just the generic concept of an outlay of money with the expectation of getting more money back. That sounds like what the earlier definition of investment was. Would it be just more descriptive to stick to the old definition? Investment is an outlay of money with the expectation of a positive return, and then distinguish among various different investment types by the type of return and the level of risk and so forth. So then we could speak of speculative investment or conservative versus conservative investment or something like that, but we wouldn't be differentiating between speculation and investment. So that's one little conundrum. But Keith, is this this OED definition really the second definition of investment, the purchase of property, shares, et cetera, or the outlay of money, I guess, for the sake of the interest, dividends, and profits accruing? Is that something similar to how you view the concept of investment?
It's getting there. So
Yeah.
first, I just want to say, unlike, let's say, the word selfishness or the word capitalism, I'm not as wedded to the particular choice of word here. There are different contexts. Obviously, there's a need for the outlay of money with the expectation of a money return, which is a broader category. Within that broader category, there are two very distinct animals, as I'm going to talk about in a minute. I'm not necessarily committed to a particular word for one word to mean this and one word to mean that. However, I do think that you can't define two similar but different concepts based on a change in degree. So, you're putting money out with the expectation of a return, and if the risk is higher, then it's speculation. If the risk is lower, then it's investment. One quibble I have with the OED is in speculation, there's a risk of loss. Of course, in any outlay of money, you're giving away your money, hoping to get it back later. There is a risk you don't. All kinds of things can happen. War, market conditions change. Who knows what could happen? Lawsuits can wipe out businesses. The Salton Sea could dry up and recede, and then your beachfront property is now, on a smelly, brackish.
Even inflation, right?
Right. So all kinds of things can happen, and there is no such thing as a return without a risk. So to define risk-free as one word and not, is first of all not even true. And secondly, I don't think you can define things based on degree of risk. My focus is obviously monetary economics, and in the monetary context, we have what I call the dollar cancer, which is the twin problems of the falling interest rate. And yeah, I know the Fed is right now playing at hiking as they did in 2015, and they'll have the same outcome, if not the outcome of 2007, all over again. We have this falling interest rate, and we have this exponentially rising debt. And in that environment, two things happen to the saver. So let's use that as a broader concept. Somebody who consumes less than he produces and has a surplus to put into something and hopefully get a return on it. And what a falling interest rate does is it by degrees deprives the saver of any means of earning a yield on that savings, and they're forcing that person to bet on the price action, to go into the casino and say, I'm going to buy this asset because someone will buy it off of me later at a higher price. And so it gives him both the motive to go do that and also the means. as the interest rate keeps falling, it becomes cheaper and cheaper to borrow money to go on margin or go on credit and use leverage to make these bets. And our financial markets today are characterized by volatile but quite high leverage.
So Keith, you're saying that these monetary policies are forcing people into speculation, whether what you consider speculation, whether they want to or not. But is that the reason you distinguish between investment and speculation, or could we say if we invested in an unhampered, unregulated market, would your definitions be the same?
It would, but it becomes a much less significant issue. So let me try to get to the crux of the issue.
If you could be sure we understand your definitions of, or your distinctions. Go ahead.
So investment, in my definition, in my thinking, is financing a productive activity. And the profit to the investor who finances something productive comes from the profit, part of the profits of whatever it is you finance. So if somebody is borrowing money to buy the machine tools to put into their assembly line to manufacture widgets, they sell those widgets, they make a profit on that, and a part of that profit goes to the investors. Whether it's equity investor, lender, debt investor, it doesn't really matter. The investor is paid ultimately from the increase in production. So society is better off because you have an increase in production. The entrepreneur is better off because he's making more money. The investor is better off because he's getting a return, he's getting his capital back plus interest, paid on that capital. Speculation, when the Fed is driving interest rate to zero, and that becomes either no longer possible or it doesn't really have enough juice in it to be worth doing. I mean, who would risk their savings to get 0.1% in an environment, Seth, as you pointed out, where inflation is supposed to be programmed to be by our monetary masters at 2% per year, and subject to stick-slip dynamics and all sorts of things where they can say, oops, it's 9%, not 2%. Anyway, so speculation is when you're making a pure bet on price, and the profit to the speculator comes from the next bettor into the casino who buys it off of you at that higher price. You're not getting your money back. You gave your money away to whoever was exiting the speculation previously, in the hopes that the next guy will come along and give you his money. And so speculation, and the profit comes from that next guy's money. Speculation acts as an engine for the conversion of one party's wealth into another party's income to be consumed. Nobody wants to be the prodigal son, but it sets alight a process of a prodigal society.
So, okay, so can I see if I can understand the distinction? So a refinery, a fluids refinery, a gasoline refinery, suppose they decide to invest in oil storage. And so they, an outlay of money for the purpose of financing production, financing production of gas. So they invest in oil storage. On the other hand, you might have someone who simply buys oil in storage to sell it later to the refinery. Why would both not be financing production?
So in the oil market, so the refiner presumably is building the tanks because they need a certain amount of storage to keep the refiner, the ships come in periodically. You have to have a buffer so you're processing continuously 24 hours a day, and you need a certain amount of inventory or raw materials on hand. So that's all directly related to production. In the case of the second guy, if he is buying simply to bet that the price of oil will rise, then he's a speculator. It's nothing to do with production anymore. He's just betting on the price.
Well, but a lot of refineries, to my knowledge, would not store too much oil. They would take positions in the futures market and guarantee delivery at a certain price from different people. So in other words, are they not then speculating in the price of oil in order to finance their?
In fact, what they're trying to do is avoid speculating. They want a known spread. So they want to buy the crude oil forward and actually want to sell gasoline diesel and other things forward. So they're operating on a known spread, and they're taking the volatility risk out of the business. I was going to say, normally the futures market is a very elegant mechanism for coordination of production, because it allows things that are produced either seasonally, like agricultural crops, or delivered in a bursty way, as tankers full of crude would be, and allows the participants to spread the consumption or the production evenly throughout the year, without being forced to take a position and essentially bet that the price is going to go in their favor. And of course, sometimes the price doesn't go in your favor. Why would you want to make an existential bet, put your business on the line for something like that? But I want to go back to, you asked the question, in a free market, would this be an important thing? The price of assets generally is inverse to the interest rate. So when you have an unstable interest rate, you have unstable asset prices. In a free market, i.e. gold standard, you have a stable interest rate. And so then asset prices aren't banging around all over the place. And then secondly, in a gold standard, you don't have inflation as we conceive of it today either. So there's no real reason and no real opportunity, perhaps more importantly, for the average person to be running around betting on prices of commodities or assets. You're buying assets or buying shares in businesses to get the yield of operating them. You're not betting that the price is going to go up and then liquidate it to the next guy. And so it's not that you pass a law that says we're not going to allow speculation anymore. Rather, the opportunity kind of dries up. All this opportunity for speculation is created by the instability. Ironic, the Fed, when it was originally created, had nothing to do with unemployment and inflation. It was to stabilize what they conceived as a business cycle. So even before the Fed, the government had various ways of mucking up business and credit and causing a cycle. So they figured the Fed would stabilize that. But when you look at graphs of things like the interest rate and other things, the Fed created the very instability that they thought it would correct. And in that unstable environment, you have volatility. With volatility is opportunity to speculate. But all of the speculation is a net drain. It's in a way, it's a pyramid or Ponzi scheme, in that one person's buying in goes to another person cashing out. And it's his income, right? So the guy who's buying in, that's his savings or capital. He's not going to consume that, but it's going to somebody as income, or part of it is income, and that person will then consume it. And so this is how we're, consuming, one of the mechanisms by which we're consuming capital, and ultimately, undermining our civilization.
Let me step in there, and Daniel, can I ask if there are any questions or super chats or anything? I'd like to get the audience involved here, and of course, I can't see what they're doing.
So we have a super chat from Jonathan. Thank you for $5. And we have a super chat from Bonnie. Thank you. And also a comment from Enric. He says, so investment is the overall concept and speculation is a method in that. So he's also kind of asking.
Yeah, in other words, is speculation a type of investment? And I think that is one way to think of it, because investment, but on the other hand, and Seth, let me bring you in on this. I'm going to read a quote from Ludwig Von Mises, which seems to contradict Keith a little bit. He says, Keith said that, if I understood him right, correct me if I'm wrong, Keith, you said that investment, as you conceive it, is the driving force of production, the driving force, of productive activity. Okay. Here's a quote from Human Action. Profit-seeking speculation is the driving force of the market as it is the driving force of production. A tendency prevails to make a sharp distinction between such purely speculative ventures and genuinely sound investment. The distinction is one of degree only, which I think you objected to, Keith. There is no such thing as a non-speculative investment. In a changing economy, action always involves speculation. Investments may be good or bad, but they are always speculative. Yet the real entrepreneur is a speculator. a man eager to utilize his opinion about the future structure of the market for business operations, promising profits. Seth, what do you think of that comment? Is that how you see it, or how do you see investment and speculation?
Yeah, I think, I mean, like a lot of things, I think Von Mises kind of hits the nail on the head there for me. And really, when I take a step back and I think about what is investing, right? Let's put speculation aside for the minute. But like when I just think like what is investing, right? Like what are we actually doing? And I see it as this. Hopefully you can see that screen, but basically I see investing from the perspective of the investor as really what I call the act of selection, right? The investor takes, the whole concept of investing is you take money or existing capital, you, for simplicity's sake, let's just say you buy something, you wait, and then you see how much money you have left, right? So if you've been successful, you have more capital. If you've been unsuccessful, you have less capital. And that equation, I think, holds true no matter how you slice or dice it. So let's say, even if I'm going to fund, just to take like Keith's example, right? Let's say I'm going to fund a productive, expansion of a widget factory. Even in that case, right, where I'm funding production, like, and then Keith acknowledged too, it's still speculative in the sense that there's no guarantee that plant expansion is going to yield me anything. In fact, it could all go bust, right? We could buy, we can increase our production and the demand cannot be there. And now I have a higher fixed cost and my actually factory or my widget production completely falls apart. So really, I don't see much different. So even the act of sort of funding production still has a considerable amount of risk. Now, when I think about investing versus speculation, I look at it from the individual perspective, right? What am I doing from an individual? And when I'm an individual, I'm doing just this. I'm committing capital and I'm hoping to get more on the other side. And really, when you think about funding productive endeavors versus kind of, gambling in the sense, I don't know if that is even really a possible distinction to make, because investing is never zero sum. And it's never zero sum, even though people think it's zero sum. Take like a pure swap, for example, like a swap trade is literally just trading money based on price. So I could actually lose in a swap, right? But let's say, Jim, you and I are going to bet on the price of gold. You bet it's going to go up. I bet it's going to go down. It goes up. I owe you money. It appears as if that's a zero-sum game. However, the problem with that definition is you don't know the context of the other side. For example, let's just say I'm an individual, right? I can have either, a changing risk tolerance. So let's say I'm selling my stock to you because I'm going into retirement. So my personal situation has changed where I want to de-risk and I'm selling my shares, even though the shares may still go up and may still go up. Or
Seth, are you saying that all investment in a fair free market, let's just stipulate,
let's
all investment is in some sense productive?
Yeah, I would even go back to Von Mises and say all action, all human action is an act of speculation, right? Because even, go back to the caveman living in the cave. To take a step out of your cave and look for food or find water, which, you will die without, requires an act of speculation, right? You don't know if you're supposed to go right or left. Obviously you will have some knowledge, which will risk or de-risk that action, but you still don't know. And I think, just life is uncertain. The future is uncertain by definition. So to try and differentiate between types of uncertainty, I don't know. I think it.
So, but let me rephrase. So, if we are talking about, in both cases of speculation and investment, assuming we differentiate, if both cases we're talking about an outlay of money with an expectation of a greater return.
Correct.
But in every case, in every case we cannot have complete certainty. isn't there always an element of speculation in every outlay of whatever this is called, this outlay of money to get a better return? Isn't there always an element of speculation in there? So Keith, I think you don't see speculation quite that way. Am I right?
If speculation means having to make a decision in the face of uncertainty, then everything's speculative, including, as Seth said, walking out your door looking for water. If that were the definition of speculation, and I said, I'm not necessarily wedded to the term.
Yeah,
I'm trying to differentiate between a zero-sum game of betting versus, financing something productive. Let me add one more piece to this. And I said earlier that the price of an asset is essentially inverse to the interest rate. So this comes down to any financial asset that produces a cash flow. The way you calculate so let's say you produce $1 a year. This is Warren Buffett, which I think he gets from Benjamin Graham. Suppose you had a machine that every year it reliably spits out $1 bill forever. What would you pay? What should you pay to buy that machine? And obviously that's an analogy for a business. Now you're taking out the uncertainty that you don't know that it will or will not produce that dollar reliably every year forever. But suppose it did. What should you pay for it? Well, it turns out that you need to discount the dollar bill it's going to spit out 1 year from today is not worth $1 right now. It's worth something less than that. And what it's worth less by is the discount factor, which I argue is the market rate of interest. So if the interest rate is 10%, then you're going to get $1 a year from now, but the present value of that dollar, what we'll call it the 1 year dollar, is 90 cents. The present value of the 2 year dollar is 81 cents, and so on. So you have a sum of a series.
You're gonna pay $10.
One plus 90 plus 81 cents plus 72 cents, ... And mathematics tells us that that's an infinite series, but it has a finite sum, and the finite sum is $10. If you cut the interest rate from 10% to 5%, what happens is the net present value of that future cash flow stream goes up to $20. And so I want to challenge you, Jim, when you said capital appreciation. Did anything actually appreciate or gain? Or did the Fed simply manipulate the interest rate downwards that tilted this equation in the favor of a higher value?
Oh, I hear you, Keith. And I don't think, I actually think that everything we call capital appreciation is completely dependent on what this asset will earn. And always should be. And you can fiddle with the discount rate for various reasons all you want, but it's the return on the asset, not some kind of a magical ballooning of the asset
and this
value.
is what they call the wealth effect.
Yes.
Right.
And it's a failure to distinguish. Yes, I'm completely on board with you here.
Yeah, I would maybe push back a little bit on that, in that, if you think about, that sort of definition of worth, and that definition of, and also sort of the concept of value investing, ultimately, go back to Ben Graham and Buffett and all those great value investors who quote unquote value, would consider value based upon that framework. What you find is that they are still trading securities in the marketplace, right? You cannot, the whole, valuation, in my view, is a tool used for investing, because there is no such thing as a quote unquote intrinsic value, right? When you are talking about a market price, which is what the price of stocks are, or what the price of bonds are, right? Any security has a market price, and the market literally defines the price. That doesn't mean it's subjective. But what that does mean is that there's no such thing as intrinsic value. Nothing is valuable in and of itself. So what this valuation work does, and the whole concept of discounted cash flows or multiples, or whatever you want to use from a valuation perspective, like valuation is just a tool for people to understand, kind of to come to some fair meaning of market price. So for example, like, why discounted cash flows is used so much, and I think properly so, is because in theory, if you have a business that is throwing off $1 of cash every year, if you buy that business for less than $1 of cash, are going to make, money on that, right? Like you literally are going to, you could put in $1 this year. I'm sorry, $1 this year. And let's say let's take the $1 per year cash flowing business and you buy it for 50 cents. Well, in 1 year, you could take a dividend from that company for the $1 and you have made 50 cents on your 50 cent investment. And then the next year it's going to spit out $1. So now you made $1.50 on 50 cents. So the whole valuation framework still comes back to this idea of being able to get a market price for something, just using kind of a tool or framework for it. So even like the great value investors require a market price and a market mechanism, which means buying and selling kind of in the marketplace. So I just find it hard to distinguish between kind of these concepts. And even if you look at kind of quote unquote, the proper way to invest versus maybe the not proper way to invest, I mean, you could see this argument all the time in markets between, say, quote unquote, value investors and quote unquote, growth investors, right? And you could see how they've performed over time, where value investing has really languished over time. And we can argue is that some interest rate manipulation, is that or not? And that is a totally valid kind of topic for discussion. But you could see that over periods of time when people are trading people are trading securities in the marketplace for whatever reason, because even companies, by issuing stock, are trading their market in the marketplace to expand production. When they're doing that, there's just all sorts of reasons, and value investing doesn't always work, and sometimes growth investing works. So I just find it really hard to kind of use this framework and say that value, this discounted cash flow is the only one true way to invest. Because when you look at kind of what works and what doesn't work, I think it's a very mixed evidence for that.
Yeah. So Seth, I got a good quote here from Benjamin Graham, who, as you have pointed out, had a very specific way of investing. By the way, I was steeped in that for many years at the firm that I worked for. So, quote, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. And then he goes on to admonish you. This is from The Intelligent Investor, and it's
of course.
It's also all in the in security analysis, is famous book. And he goes on to admonish people: never mingle your speculative and investment operations in the same account, nor in any part of your thinking. Still, when you parse that, an investment operation, upon thorough analysis, promises safety of principal. Well, how much? How safe?
Yeah.
And an adequate return. What's adequate?
Yeah.
Yeah. So he goes to great lengths and gives many examples, concrete examples, concrete after concrete after concrete, in The Intelligent Investor, to distinguish between investment and speculation. And he even says, he characterizes the market basically as a bunch of speculators out there that you should take advantage of. The Mr. Market analogy. There's a guy named Mr. Market, and one day he wants to sell you a great business at a ridiculously cheap price. And he'll come back 3 months later and want to buy it back from you at a ridiculously expensive price. But you, the intelligent investor, you know what it's worth, and you are going to buy from him when it's got the stock on offer and sell it. And then he sets up rules. Actually, this works pretty well. This works pretty damn well. It's a method and it's a discipline. But as you pointed out, with intrinsic value, there's conceptual issues with it. Yeah. What's intrinsic? There's no such thing.
Yeah.
So, but I don't want to characterize this. I don't want to characterize this. This is not necessarily what Keith is saying, but It's a little bit close. This distinction between investment and speculation.
Oh, I disagree that he's close to me. He's saying again.
Okay, good.
Differentiating these two concepts by degree of risk, or he's even kind of hand waving over that one of them doesn't have risk. It's safe. And that's, to me, that's a little bit of hand waving. Of course, it has some risk. Yeah. Maybe really low. It's a AAA rated bond. I mean, what's the risk of that defaulting, during the 2-year loan term? Pretty darn low. But I don't I don't think I mean, in general, right, thinking about objectivist philosophy, you don't want to define, concepts, differentiate concepts purely by degree. You're looking for some essential difference, not a degree, not a difference of degree only.
Well, I also want to do justice to Ben Graham. Now, let's face it, this was a brilliant man and a famous professor who was Warren Buffett's mentor, and his methods and disciplines have made many, many people rich. He's not a fool. I wish he were here to, discuss this with us, but he can't be.
Yeah, as an investment thesis, I certainly couldn't quibble with that, nor could I quibble with what Seth said, that, in recent decades, this hasn't worked as well as it did in Benjamin Graham's day.
Yeah.
And of course, it's the interest rate manipulation. One other variable I want to throw into all this, and I totally agree that value is not intrinsic. Although I don't think the people who use that term, like Buffett, intrinsic value, I don't think they mean it intrinsic in the philosophical sense. They're in a different context and they mean something different by that term. And it's obviously not subjective either. I mean, a security isn't worth whatever you feel like at the moment. I mean, clearly that's not right either. As an economist and one who really hails back to Menger, I think that the way markets work is based on arbitrage, and that really is based on spreads. So if there's a market rate of interest that you could borrow at X% interest, now that gives you a basis of comparison for that security. Again, there's risk there, but if you can borrow at the market rate of interest and buy that security and have a positive spread in your favor, that becomes very interesting. And if the spread is negative, then that becomes a lot less interesting. And of course, it isn't just you who has that choice or that arbitrage. Everyone else in the market has that same interest rate. And the CFO, if this is a corporation now and we're talking about equity securities, the CFO has that option as well. So if the company has a earnings yield of, let's say, 5%, and the company can borrow 2-year money at 2%, which until fairly recently it probably could have, then that's why companies were borrowing money to buy their own shares. It was essentially they were recapitalizing equity as debt because it was cheaper. And so now this concept of value becomes relative value, this versus that, interest versus, versus dividend yield or versus earnings yield. And that gives you some sort of anchor. And that's why when the interest rate falls, discounted free cash flow, net present value analysis rises. And you may not agree with it and you may not want to be a buyer. And I think the point to which Seth alludes is that the more that you stick to your guns, stick to your Benjamin Graham, philosophy, the less you'd be buying, in the late 1990s and then, post, let's call it 2015, 2016, when things started to really get frothy again. You couldn't really be buying anything because that metric says everything's overpriced. So if you wanted to be a participant and make money in the markets, it wasn't going to be by Benjamin Graham anymore.
Well, so Keith, to your point about speculation, we have certainly seen rampant, what most people would call speculation, as the Fed has cranked down rates, and it's just, people trade things that you never thought they'd be trading. They trade memes, they trade. I can't believe what people quote invest in today, and I agree with you in the sense that it is hard to call some of this stuff an investment. Some of the things that people put their money into today. I'm pouring out my guts here. Okay, so let me pause here. And Daniel, can we get any questions or anything that's come up from the audience before I pose one more question? Because we have about 15 minutes left.
Yeah, we have a super chat from Gian. Thank you so much. We have also a super chat from Enric, and he asks, how price is determined is an idea I'm interested in. How value is determined between parties?
Okay, so how price is determined and how value is determined between parties.
It's more than a $4.99 question.
Yeah, it's yeah. So how about anything come to mind, gentlemen, about where you could read about this, read about pricing theory. But this not too, I don't know, not too esoteric. Anything
Well,
come
I
to
would say
mind?
this. Well, like this is a big part of my framework that I write about, on my blog. So you may want to check that out. Nothing specifically comes to mind. Although maybe there is an idea in there called like how I process investment themes into investment ideas or something like that. But I think like basically in your question is your question kind of answers itself in that these are two different concepts, right? How is value transformed into a price, right? Those are different things. And one of them, price, is an objective observation. You literally just observe the market price for something because that's just what it is. Value is a personal objective determination, right? And what's value to me may not be value to Jim or value to Keith, because quite honestly, our contexts are changed, right? Like, let's say I am a 22-year-old and I am going to buy stock. My risk tolerance and context is totally different than if I'm an 85-year-old owning a stock, right? Like the value of owning a stock at whatever price and whatever valuation or whatever is much higher to a 22-year-old because they have all their life ahead of them, and like there is a much more possibility of return versus the amount of risk there, versus the context of like an 80-year-old who again is risk adverse because again they're more interested in the in maybe in the certainty, right? They're risk adverse, and so they value that potential for appreciation differently. So people value things differently, and the price is the price. And that's what makes the investing, the quote unquote investing job difficult, is trying to, or really the crux of it is like, how do you find value? How do you define value, and what prices can you get out there for investments that you can really use in this broader, the broader concept of making your portfolio meet the goals?
Okay, good. I want to give a quick plug and get Keith jump in. A quick plug for Jonathan Honig's book, Price is Primary. I believe that's the correct title, and I think Jonathan may be listening in today. But that may have some insights to what you are getting to in that question. I believe you can find that book on Amazon. Keith, did you have any comments on that price and value question?
Yeah, so a lot of objectivists get caught up in Austrian economics because it uses the word subjective. But I think Menger was very Aristotelian in his approach to that. And the 20th century Austrians have gone more to philosophical subjectivism, which is not what Menger meant. I think that as an individual actor, you think about value in terms of relative ranking. I go to market for food, but I want meat more than I want green, or I want this more than I want that. And you kind of have, a hierarchy of needs. Maslow obviously talks about this in different contexts. You have a hierarchy of needs of this is all the stuff that I want, and this is the most urgent, and this is less urgent, and so on. And then you go to market, and I'm talking about commodities and consumer goods now, and I'll get to investment in a moment. And you go to market and you see all the things that are available, and they're all ranked by price. And now you have to kind of perform a matching function of, well, I have this much money in my pocket, this many needs I want to fill. These are all the things that are available. Well, crap, steak is $49 a pound right now. Chicken is $2 a pound. I guess chicken is going to be how I satisfy my meat, my value for meat today, and not steak. Financial assets, I think, not to oversimplify it, and I'm not a trader, as I think Seth is, and so my perspective is going to be different. But I think financial assets, again, you always have that market rate of interest as your benchmark. And not only you, but everyone else on the market can be borrowing at that rate to either buy the security or buy a different security. And so, you're looking at what's the, they use the term intrinsic value, and I don't think they really mean intrinsic as objectivism defines it. intrinsic value of the asset is. It's just, net present value, and then a premium for the risk. Each asset has a degree of uncertainty, and some of those uncertainties are higher. Some others uncertainties are much lower. What's the risk that Berkshire Hathaway is going to go out of business tomorrow is a different risk than what's the risk that, some little bodega in, Colombia is going to go out of business, a very different risk. And you have to try to assess that somehow, and that's obviously the challenge. And if you can buy the asset cheaper than, it's discounted free cash flow minus the risk premium. If you can buy cheaper than that, you got yourself a bargain, from a financial investing perspective.
Okay, so we're going to run out of time here. Can I ask each of you to maybe summarize in 25 words or less, why should people care about investment versus speculation? So this is a pretty free-ranging discussion today and touched on a little bit difficult topics. But Keith, why should people care?
So I was in a debate about Bitcoin the other day in the Soho Forum, and I established in a way that the other guy couldn't refute that Bitcoin is a pyramid scheme, in the sense that the only money that anybody takes out as a profit is the money that's put in by the next group that's coming in, right? So when you buy in, you're giving some exiter your money, hoping that the next guy is going to enter and give you your exit. And also, it requires tens of millions of dollars a day to actually operate the network, for all the electricity and the mortgage on all the computer equipment and so on. And all the miners are taking out their VIG of tens of millions of dollars a day as well. The miners get their piece, and all the exiters get their piece exclusively from the fresh money coming in. And so from the individual balance sheets perspective, to respond to what Seth said earlier, if you bought at 16,000 and you sold, today at 22,000, you have a gain in capital. However, if you look at the aggregate balance sheet for the economy, it was a zero sum or a negative sum game. Whereas investment, as I define it, if you finance that widget factory and now we're producing more widgets, everybody has been enriched. The the balance sheet of the economy as a whole has increased, not just the balance sheet of the investor. And that's why I think there's an important distinction here.
Okay. Keith, I want to just tout that. Would you tell people where they can find that debate?
So the video, as of this recording, the video is not out yet. So on Tuesday night, you could have paid $6 to watch the live stream. The Reason Foundation will be releasing the video on YouTube. I've been told it would be within 6 days, which would put it into next week. Anybody follows me on Twitter, I'm at Real Keith Weiner, or I suppose I can give it to the Ayn Rand Center UK. As soon as I have that YouTube link, I'll post it. And
of course, you'll post it on, if you can get it, you'll post it on your Monetary Metals website, of course, too, right?
Yeah, we'll send out a mailing when it's out.
Yeah, great. I'm looking forward to that. Seth, why should people care about
this? To me, what I've gone through has literally changed my life, as silly as that sounds. Because I used to, I've been in this job for a long time, and I used to be of the sort of, I can't speculate in a sense, right? To be an investor, right? Investor is one who invests. Invest is literally just a commitment of capital and hoping that you get more in the future. So I would go and I'd sit and I'd do these valuation exercises, and quite honestly, then you don't want to buy anything because you just don't, because you're scared in a sense. And then, or I was scared, I won't speak for anyone else. And then you miss out, you have bad returns. So what I was able to kind of merge these two concepts, it let me approach investing from a different perspective. My only goal as an investor is to make more money with the money that I am committing. And now I have a way, and I posted into the YouTube chat an article I wrote. I have a way to make sense of the entire world. This is what investing is. And what philosophy does, it helps us make sense of the world. So I now have a two-pronged framework where I call it value investing and momentum investing. One is based upon kind of trend of the price going up for almost like whatever reason. And the other one is kind of the traditional value investing where you're expecting the price to change its direction, either up or down, if you're buying or selling. And, just approaching investing from this perspective, I mean, it literally has been more profitable for me. It's been psychologically freeing. So it's really it's really changed my life to sort of merge these two concepts together instead of keeping them separate. And I'm going to just sneak something in here real quick, is that there's this perception that definitions matter, right? There's a perception that speculation equals gambling. And they're very different, right? Speculating, quote unquote, on an investment market where you actually don't know the unknowns is very different than going into a casino and playing at the table, gambling at the tables there. In the casino, there are known odds, right? The odds are stacked against you, like by definition, right? There's a closed system. Investing is not that. So when you sit down at a blackjack table and you put money down and you are gambling, or you literally are expecting to lose. In investing, you don't know the future, and you're not putting money down expecting to lose. You are putting money down expecting to win. So because you don't know, because of an open versus closed system, speculating and gambling apply in completely different contexts, and they shouldn't be confused.
That's a really great point and a good analogy to what investing is not, gambling. And I'm just going to sneak something in. You're talking about marrying value investing and momentum investing. That was a big controversy at Brandis Investment Partners, where I was for many years. There was the pure value guys, and then the guys who apparently saw what you saw, that if you look at the momentum, you can juice your returns and select your stocks a lot better. Anyway, it was interesting. I shouldn't have said, we shouldn't get into this. This is investment. This is not investment advice. Okay. With that, thanks to both of you. This is really interesting to me. I hope it was to everyone else. Fascinating discussion with two very, very thoughtful guys, two of my favorite people. So let's wrap up here. You know where to find each of these. I read on Substack. I'm Hard Money Jim. And I am going to post this on my Substack page with a little blurb. And with that, let's, do we have time for any more quick comments or chats, Daniel, before we sign off?
We just have a couple of super chats. Duan says, thanks, great discussion. Gail says, thank you, great content. And on the funny note, Steven says, I know you cannot provide investment advice, so please provide speculation advice on where I should invest all of my money right now.
That's great. Oh, man.
Yeah.
All right. Well,
how that would fly in the face of the regulators.
You think?
It's not investment advice, it's speculation advice.
All right. All right. Well, thanks, everybody. This was really fun. And I should be back next weekend or next Friday with more on money creation and its consequences. So thanks to everybody, and have a great weekend. Bye-bye.